But now the auction for U.S. Treasuries produced some pretty excellent results for the government. The yield was below what many had expected, but can this last? Well, let's turn to Larry White. He's a professor of economics at NYU Stern School of Business. We also have Dan Greenhaus, analyst and strategist at Miller Tabak. Gentlemen, welcome. Larry, let me begin by coming to you. Were you surprised by the yield on the Treasury auctions today? I mean, everyone was looking for something over 4.8%. We didn't make it.
Well, there's still concerns, I think, in the marketplace about safety, less than a few months ago, but still the Treasury still looks like a pretty good place to be parking money. And so I think that's still being reflected in auctions like this.
Dan Greenhaus talks about the Treasury and perhaps this idea that, Treasuries are still safe. Any surprise in your mind that Timothy Geithner, the Treasury Secretary, didn't he just get off of a trip? Could we call it a sales trip? After all, aren't the Chinese the biggest buyers of U.S. Treasury debt?
When it happened, we jokingly referred to it as a road show.
A road show. I like that. A road show for U.S. Treasuries.
Right.
Finally, well, thank you, Dan Greenhaus. Finally, someone that's willing to put a real professional face on what went on. So what happened?
Going into the auction, we've obviously seen a sell-off in the Treasury market for several days and several weeks now, pushing yields up. And so going into the auction, one thing that was drawing my attention was the fact that at 4% on the 10-year, at 5% on the 30-year, give or take, you're probably getting to a level that presents an attractive investment return for equity investors. And the question at these levels is going to be not in addition to concerns about supply and inflation, you're going to also have concerns about whether or not a 5% yield or a 4% yield is the type of yield I want to lock in over the next 10 years if we're going to have the type of lackluster performance that some people think we do.
But how do you, come on, we got to back up a little bit and query this because, 4%, 5% attractive to equity investors? Equity investors are hooked at least on 10%, right? When you take off what it costs in terms of taxes, after-tax yield isn't going to be 5% if you invest in treasuries.
Well, historically speaking, when you take a look at the equity risk premium, certainly equities pay for the risk that you undertake. I think the argument with respect to whether or not 4% or 5% presents attractive returns is with respect to whether or not equities are going to have the type of returns that historically we've been associated with. Now, I'm not necessarily making that case. I'm just merely saying that perhaps at some yield, not necessarily that different from where we are, they may present an attraction. And the other point I would just simply make is that, related to the sell-off in the Treasury market that we've seen before the 10-year and the 30-year auction, some hedging that had been done by some mortgaged investors had all been pretty much taken care of from what you hear around on the street. And so the fact that you saw some relative strength in the 30-year wasn't entirely a surprise.
Larry White, a road show for Treasury Secretary Timothy Geithner, successful? If you were listening to that road show, would you buy it?
Well, I think yes, because I don't think we're going to see serious inflation over the next few years. A lot of the commentators to the contrary notwithstanding. And, we still are a secure place. We're not going to go up in smoke. And so, yeah, I would have bought it. I think he did a good sales job. I think he reassured the Chinese. And
But let me just follow up then and press you. How do you go from there to looking at the size of the U.S. deficit, looking at the balance sheet of the Federal Reserve, going to all of the stimulus programs? Can the case be made that a potential investor says, you know what, I'm going to sit on my hands and wait. Yields are bound to get higher.
You got to remember that a lot of the balance sheet of the Fed has the counterpart to all the liabilities it's issued, a bunch of assets, as we're seeing. TARP funds are getting repaid. There's going to be some return on our investment in AIG. There's going to be some return on the investment in the Bear Stearns support. So, there's going to be paybacks happening. So I think people who just look at the outstanding liabilities are not looking at the full balance sheet.
All right, we're going to continue the conversation. Coming up, we're going to find out if the rebound in treasuries is real and if the economy is still healing. Won't yields actually climb? We'll find out about all these green shoots. And what does this do to bank profits if yields go up? How about that yield curve? We'll find out. This is Taking Stock on Bloomberg. This is Taking Stock on Bloomberg. I'm Pim Fox. Will yields on U.S. treasuries rise? And if so, why would you be buying now? Let's continue our conversation. We have Larry White. He's a professor of economics at NYU Stern School of Business, and Dan Greenhaus, strategist at Miller Tabak. Dan, what's the likelihood that rates go up? I mean, you heard Larry say, well, we're not going to get so much inflation. Yet there are a lot of people that say, look out to the future. I mean, we've had Peter Bookvar on from Miller Tabak. He's saying there's going to be quite a bit of inflation. So what's the outlook for yield?
Well, there's two things in play here, and I'll try to get through this as quickly as possible. The first is whether or not we experience commodity inflation, and the second is whether we experience wage inflation. I think going forward, we're going to have to separate the two, and a strong case can be made that from a wage inflation standpoint, we're going to have none. Whether it's the output gap or the high level of unemployment or just the overall slack in the economy, there's no pressure to raise, there's no pressure on wages.
No one's going to be making any more money.
100%. Right. At the same time, when you look at the flooding of the global economy, the carpet bombing, if you will, with dollars, with euros, with everything, there's going to be upward pressure on gold, on some precious metals as an inflationary hedge from that vantage point. I think with respect to the people who are looking for high levels of inflation in the next couple of years, there are ways to mitigate that argument. Getting back to something that Larry was talking about earlier with respect to the Fed's balance sheet, a large percentage of the Fed's balance sheet, 25, 30%, whatever it is in these programs that are basically designed to expire in a relatively short period of time. The Fed can simply stop the continuation of those programs or perhaps make the terms of them more onerous to reduce the reliance on them, thus just merely shrinking the balance sheet simply by not doing more. So there are holes in the argument. That said, I agree, things like commodities and Treasury inflation.
Because we've already seen it, right? I mean, even in your most recent note, you're talking about energy prices, and I want to get your thoughts there. Energy prices, $72 a barrel for oil. We see a rise today. I mean, really, is natural gas really 6% more today than it was yesterday? According to the futures market, it is.
Well, besides the demand side of things, with respect to commodities and oil and all that sort of thing, there's a supply issue, whether or not the underinvestment that the economy is undergoing right now with respect to producing and providing those supplies, whether the supply is going to decrease and you're going to see an increase in prices going forward right now, not just on the demand, but on the supply side.
Larry, let me come to you because it seems as though, we recognize that the Treasury and the government has a vested interest in selling this debt at the cheapest possible price. I mean,
sure.
they don't want to have to pay 5% for a 30-year IOU. Having said that, when you look at what's going on in the energy market, who's the vested interest in making sure that energy prices rise? Because, we've seen, as I said to Dan, $72 for a barrel of oil, yet we don't see huge demand. In fact, gasoline usage is down. Huge inventory supplies of natural gas, yet natural gas goes up 6%. Are there vested interest players that want the price to rise?
Well, for sure, any net supplier in the Middle East, in Northern Europe, Norway, South America, those
the producers,
guys, for sure.
The basic producers.
For sure. After that, I mean, we as net importers, we're net losers anytime energy prices go up. We got to pay more for our oil, and that's a net drain out of the U.S. economy. Within the U.S., anybody who owns a oil well in Oklahoma or a natural gas a lease or a coal seam benefits, but net, the U.S. is a loser. So, the Treasury, the U.S. government, surely does not want energy prices to be going up.
All right. So if the government doesn't want energy prices to go up, do you think that they can do anything to put a cap on energy prices? Because it seems as though that is off the table in terms of really changing the way people consume energy.
Well, we went through that in the 1970s. I think we learned our lesson that trying to put price controls on something like that at the end of the day doesn't work and has a lot of serious dislocation, inefficiencies attached to it. There are things that you want to do, encourage alternative supplies, encourage greater efficiency to reduce demand or add to supply, but trying to put caps, ceilings on prices, I hope we learned our lesson. You never know. It isn't over till it's over. But I think and I hope we learned our lesson.
Dan Greenhaus?
And, it's good that he brought that up, because this is one area where Barack Obama has a lot of support from the public, not just Democrats, but the public at large, which is our desire to get off our dependency on foreign oil and invest in alternative energy, solar power, whatever it may be, wind power.
Yeah, but make the case, because foreign oil, we're talking about gasoline here. This is really all about gasoline. This is not about natural gas. It's not about coal.
It's all about converting our energy usage to be homegrown. Irrespective of where it comes from, irrespective of which commodity we're talking about. I would just simply say whether the government goes about it correctly or they have the correct method with which to implement it or to direct investment in that manner is a separate conversation. I'm just simply saying that there is broad support and there is broad agreement with respect to the fact that we could be doing more to provide energy for ourselves here at home.
Okay, now let me just connect the 2 points, because we started talking about treasuries. Is this going to be expensive? And if it is going to be expensive, don't you think that yields are going to have to go up? I mean, it's going to cost more whether we're running a deficit because we're helping the banks or because we're trying to implement some kind of energy policy, Larry?
Of course it costs something. You don't get anything for nothing here. There are no, or at least not very many, free lunches. And so, yes, it's going to cost something. The real question going forward, once the economy starts to turn around, are we as a society, willing to tax ourselves or otherwise make sure that the cost gets covered in some reasonable fashion?
Right.
I like to think we have the maturity to do that, but that's a political process.
Right.
And
we'll have to see what happens. Thank you very much, Larry White and Dan Greenhaus.